All right, welcome. I'm Chris from the ACA Academy, sometimes known as Coach Chris, and I'm excited to tell you all about HSAs and why, if you have not sold HSAs, you need to sell HSAs for next year. I don't know if you guys want to raise your hand or click the little button. How many people started selling insurance during the COVID Biden era? That's, Josh did, Dwayne did, Adam raised his hand. Like, if you didn't sell this beforehand, this is kind of new for you, this income cliff, and it's going to be a big deal. And so you have to think, how do I get people on the marketplace? Now, I am 100% a believer that the ACA is the best insurance. It's got no limits. It's got all your free preventative. It's got copays. Like, you know what it is. If I can qualify somebody for it, that's what I'm going to put them on. I'm not going to sell them a short-term plan when they can get a marketplace plan for $100. Like, why would I do that? But you do need to know how to help people. So next year, if you haven't had it, and I don't know, Joshua, if you've got it, that you could just stick it in the chat as an attachment. You need to get the 2025 federal poverty chart. It might say 2026, but we have it. This is what you see, here's 25. And Josh, if you've got it, if you could attach that. Here's my 2026. It's sitting right there next to me, so I can look at it. The 400 FPL for a single person next year is 62,600. For a couple, it's 84,600. Family of 3, 106,600. And a family of 4, 128,600, and so forth. So that is the 400 FPL. FPL stands for the federal poverty limit. They come out around somewhere in March, April, May. The government looks and they go, okay, we think, and they look at last year, they go, all right, the federal poverty limit is whatever. And every year it goes up, cost of living goes up, so poverty level also goes up. Well, that means when we call about the income cliff, if somebody walks into my office and says they make 62,600 right on the dot, all right, you qualify for a tax credit. If they file their taxes, and they actually make $62,601. The government says you did not qualify, you owe all of the tax credit back. Not some, not a portion, all of it. All right, so look in the chat. There's a downloaded. This is our federal poverty chart. You've got it, keep it, put it where you can see it so that as you're talking to people about next year, you know what it is. Right now, because there is no cliff, if somebody tells me they're going to make 62,000 and they file their taxes for 24, 25, and they made 72,000, they're $10,000 over. They have to pay back about 10%. That's the easiest algorithms. Like, all right, you're going to owe back about $1,000 because you underestimated your income. Not next year. It's not prorated. Now, it's prorated under the 400 FPL. If somebody says I'm making 31,000 and they make 40,000, all right, it's going to be that prorated amount. But the cliff, it's not prorated. And it is literally $1. Like, what? And you hear about people that still talk about it. They're like, oh yeah, I had a huge penalty way back in 2017. Well, it's not that it was a penalty. You just didn't qualify. It's all or nothing. You either qualify or you don't. And if you don't, you have to pay it all back. All right, so is that kind of starting to make sense when we talk about the cliff? It's not a gentle, gradual, slow. Nope, you either get it or you don't. It's a cliff. You'll fall off. So you have to have that 400 FPL memorized. And on top of that, you have to keep in mind that next year's max out of pocket is 10,600. I don't even know how CMS can justify a $1,400 increase in 1 year. I'm like, I I actually raised my hand at when I was in, DC at the end of June going, "Excuse me, what?" Like, I will tell you of all the changes, it's probably the thing that's pissed me off the most. Don't tell me you care about families and you just gave a family of 4 with 2 kids that are barely surviving a potential of 21,000 out of pocket. Like, what? So they could be paying full price plus also have 21,000 potential out of pocket. So you asked Chanel, a person needs to be at 400 or lower. Correct. And if they think they're going to be at 400, you better make sure I mean, I remember telling people when they walked out of my office, under no circumstances can you go over 54,572 or 62,785. Like, I was telling them the dollar amount. I'm like, you cannot go over. And if you think you're going to go over, you're going to call me. You're going to call me as soon as you think, and we're going to brainstorm. We're going to figure this out. Do I need to take you off right now and you're going on an alternative? Oh, your kid. In fact, I remember a person who was in college, and okay, he's in college and he was going to graduate. He graduated in May. She called me. She's like, "Take my son off right now." And I'm like, "Well, what happened?" He got a job as an engineer making $100,000. Just, I don't want to get him off right now, right? So you want your clients to call you if they think they're going to go over. This is also the perfect opportunity for you to connect with financial advisors. Love financial advisors. Reach out to all of them. Print off of things saying your clients need to know the income cliff and let them know. Go to everyone in a 50-mile radius around your house saying, I just want to make sure I'm teaching some classes. I want you to know whatever it is that you can go out to financial advisors because you need them. You need them to help. They know their clients, especially if they're retired. There are some catches. There's some things to be aware of. I got to be a little bit of a financial advisor accountant as this happened. If somebody gets an annuity, they inherit an annuity, they can't waive that. But they're like, it's just a $20,000 annuity. And they're not thinking, and they cash it out. Well, they just increased their income by 20,000. And now they're over the cliff and they have to pay $24,000 back in tax credit. What? Like, yep, that can happen. It's better to not cash that little 20,000 or 10,000 or maybe 5,000 annuity if they're that close to the cliff. So I only had one person the year of 26 when he left, and the 2 years that I had to tell people you cannot go over. I only had one person and he didn't listen. He cashed out his 401k to buy a car. Must not have been a very big 401k, but he bought himself a brand new truck and he had to pay it all back. And he's like, "Well, that was dumb. I didn't know my 401k was income." And I'm like, "You pay taxes on it, right?" So just make sure they all know. Now, why am I bringing all of this up? Because HSAs is a way to help people who are just over the cliff. And I'm going to answer a couple of questions. Do you need to start an HSA if your plan allows? Yes. If you are enrolled in a HSA qualified plan, and I'm going to put a caveat, put a sticker on that. So Congress just said if you enroll in a catastrophic or bronze plan, you can put money in an HSA account. I am getting clarification from that because I could see CMS doing one of three things. One, saying, well, there can be no $0 deductible bronze plans. I could see them saying that. And if they do, holy cow, talk about screwing people because those are great plans. I could see that happening. Two, they just go, yep, catastrophic bronze. All right. And the third option is that they start separating bronze versus expanded bronze. They may go, okay, it has to be a Bronze, but not an expanded bronze. So right now, I'm gonna go with the assumption that it's just bronze plans with high deductibles, not a $0 deductible plan. As soon as I get clarification and I have, well, I'm telling you, I'm talking to CMS, insurance companies, like everybody. As soon as I know, I'm gonna send a video quick and I will update everybody. But for right now, just because I feel like they don't care, I'm gonna assume the $0 deductible plans will not qualify. So when I'm talking about HSAs, if they do, perfect. It's going to be even better. But when I walk through the HSAs, I will let you know. So you do need to be enrolled in a bronze catastrophic plan, and then you can go to the bank and open an HSA. Are we for sure going to have the income cliff? We are. Assume it is. CMS is assuming there's nothing in the rules. The big beautiful bill didn't do it. Nothing that's currently in Congress is talking about it. Assume it is. This is, you have to start telling your clients now. You need to start researching alternative plans, which I will have a webinar on, kind of the cheap ones, the middle ones, expensive ones. And you can say, oh, they're all junk. Well, then you decide, is it better to have some coverage or no coverage? Because I can tell you right now, if somebody's making too much money to qualify and they're healthy, they're not going to take the marketplace. You're going to have that 1% that does. There's always the one who's willing to. So you need to offer something. So at future class, we will be talking about some of those alternative options, but it is coming back. I'd rather tell all of my clients it's coming back. I have classes set up to teach all my clients and public. And if, I don't know, on October 23rd, President Trump writes some executive order where it isn't, great. You can tell your clients relax. But if you can't tell your clients relax, yeah, don't wait. Hoping that they're, as a Hail Mary, don't wait. Because as of right now, it is coming back. Do we have to pay back the whole subsidy or portion? So again, if you're over the cliff, if you're over 400%, you have to pay it all. Now, remember, you're only paying for the months you're enrolled. I did have people call me mid-year. I'm going to be over. All right, we termed their coverage as of June 1st. They only have to pay January, February, March, April, May. You're not paying for a year. You're only paying for the months you used it, but you will pay it all back. If you're under 400%, it's the same thing. Now, I personally, there was some rules where you didn't necessarily have to pay it all back. I never told my clients that. I always told them, if you're over by $100, you're going to pay $100. If you're over by 2,000, you're going to pay. So it is on the sliding scale if you're under 400, but if you're over, it's all. Not part, not, hey, you only went over by $10, doesn't matter. You pay it all back. And those who fall under 150, or we should say 100% of the federal poverty level, will not have to pay any of it back. That was removed. That was part of the big, beautiful bill in the House. And that one was removed very, very quickly by the Senate. Thank goodness, because what kind of moron is going to try and get $12,000 from somebody who makes $12,000? So if you go under, if you say, I think I'm going to make 18,000, and you lose your job and you make 13, you do not have to pay it back. I don't know where that started happening. People started thinking that you have to pay it back. So you do not have to pay it back if you fall under the 100% of FPL. Gwen asked if I do weekly webinars. I do not. I'm too busy. I do once a month. So it is the fourth Thursday of every month is when I do the webinars. Previous ones are still on YouTube. So, and then Josh, if you could reshare that federal poverty chart, looks like a couple people lost connection. Dwayne, pre-existing conditions on those alternatives are going to be explained. Yep. Some have them, some don't. There's some things you have to give your clients options. For HSA, doesn't it have to be an HSA in the name? No, Sharon. That is why Congress threw that out. So Congress said all bronze and catastrophic plans. So we are still trying to figure that out. Linda said, I thought repayment caps went away. Yes, the repayment caps, which was people between 100 and 400%, there was a cap that went away. So you're going to pay the full amount. But if you're over 400, there's never been caps on that. It has always been if you're over 400% of the FPL, you're going to pay it all back. And thanks, Ryan, for bringing us into the next segue. What is the point of an HSA? All right, we are going to show that right now. Let me share my screen. I think we've also had plenty of people logging in. All right, HSAs. So again, this may change. I will let you know if this applies to $0 deductible plans as soon as I know. Believe me, it's one of the things I want to know. But I'm going with the assumption that it's going to have a high deductible. It just may not be a high deductible qualified plan like it has in the past. All right, there are 4 advantages to HSAs. So whether they're in an HSA plan or just in a bronze plan or catastrophic, these are the tax advantages. So an HSA, tax-free savings account, you use it to pay medical expenses, prescriptions, dental bills, glasses. There is a lot, and they keep adding. You can go to HSA store online and see all the things that qualify to be used as an HSA qualified purchase. You put money into an HSA qualified account and it sits there. If you don't withdraw it, it's for anything like you can put it in there and then buy a TV, but if you get audited, you're going to have to pay back fees and penalties. Any money withdrawn for medical expense for those qualified stuff, you will never pay taxes. It's the only tax-free account that I know of that the government's going to give you, right? Everything else is taxed. 401ks, IRAs, you're going to get taxed when you pull it out. This one, it's tax-free and you don't pay taxes when you pull it out. As long as you keep doing it correctly, it earns tax-free interest. In fact, if you put enough in, HSA Bank was in my office a couple days ago, and there's a certain amount you have to have, and then once you reach that, you can start investing. Well, if you invest it and let them invest it, you get to keep all of that investment. So it's a pretty cool tax advantage. The main requirement to opening an HSA traditionally is that you have to be in a qualifying high deductible health plan, and they usually have no copays. Now, Congress changed 2 things. They said you could keep Teladoc. That's been a big fight. So Teladoc, HSA companies and plans were trying to give you Teladoc for a copay. But traditionally, a qualified plan meant you didn't have any copays. You had to pay 100% up to the deductible, whatever that was. And then you may have copays or you have coinsurance. They had removed the rule for that for telehealth during COVID. And now it is officially ruled that you can be in an HSA plan and pay a copay for a Teladoc. But again, they just said bronze plans. So Congress doesn't necessarily know how this all works, said any catastrophic and bronze plan. So there are bronze plans that have copays. They have high deductibles, but they have copays for like just your regular doctor and maybe prescriptions. So that could be what we might be moving to. You can't get it if you're enrolled in Medicare. Once you are eligible for Medicare and you're individual, you have to go in on Medicare and you cannot contribute to an HSA. You can only do that if you're still working and in an HSA plan through work. You can't be enrolled in TRICARE. You can't get the VA benefits. And it has to be qualifying health plan. And by the way, this HSA rule that Congress did is only for individuals. For any of you that sell group products, you can't just sell them a bronze plan and they get to go put money in the HSA account. Okay, so this is only individuals. The federal government is who makes rules about what is and is not a high deductible health plan. Traditionally, you have to reach the deductible first, sometime, except preventative. Preventative is still included. But traditionally, you reach the whole deductible first, then you either have copays or coinsurance. Typically, the max out of pocket is less than the traditional bronze plan. So remember what I just said, 10,600 is next year's max out of pocket. In an HSA bronze, next year it's 8,500 or 8,400, can't remember, but it's a couple thousand less. So somebody who said, why would you enroll in an actual HSA plan? That could be why. So here is two plans that have quote unquote high deductibles. So this one, 6,850 is the deductible. This one's 8,500, right? They both have high deductible plans. In the past, the one at the top here that says HSA was the only one that was allowed for you. You had to be enrolled in that to be allowed to contribute to an HSA account for tax deductions. Next year, it'll probably be both of these. They both have high deductibles, but this one has some copays. They have a copay for primary care, specialist, prescriptions. If you look at catastrophic plans, which is for younger people that are healthy, some of them have no copay for primary. They have a high deductible, might be 8,500, but they have no prescription or no copays for regular doctors and chiropractors. So these are two plans that you might want to look at. So traditionally, again, they both have high deductibles. In the old days, it would have had to say HSA plan. Now, I don't know. I mean, the insurance companies just got thrown the big, beautiful bill. They don't know what's happening either. They don't know either. It might need to just say these bronze plans. It might say HSA, or maybe it's a bronze plan. So we will know as everybody else knows. I'm sure CMS is also going, what the? But the reason you would want to enroll somebody in an HSA or bronze plan is because of this contribution. So remember, I told you somebody can make 62,600. Well, if they think they're going to make that, what if they're going to make 63? They're $400 over, no tax credit. With the tax credit, let's just assume their cost is 400. Without, it's 1,000. You enroll them in an HSA qualified plan, whatever that's going to be for next year, and that individual can put up to $4,400 into an HSA plan. That instantly makes their $62,601 less by $4,400. And I tell people, would you rather pay the government or the insurance company the full cost, or would you rather pay yourself? Go to your bank, open the HSA. Maybe you can only contribute 400, but you're over by 400. Okay. And the IRS doesn't care where you get that money from. I have had people in the past that went over the income cliff. Thank goodness they rolled in an HSA plan. They didn't even know, and they got money from their mother to put into the HSA to put their income just under the cliff. If I'm telling somebody your plan is $800, but if you go to the bank, $800 a month, and you go to, $800, I have to pull up my calculator. My brain does not work that fast. 800 times 12, it's going to be $9,600. That's how much premium you're going to pay. But hey, if you go put $1,000 into this HSA, instead of 800, it's going to be 300. So you're going to only pay 3,600. What would you do? HSAs, find the HSA bank online. Go to your bank, ask them how it works. The IRS doesn't care if it's a one-time 4,400, if it's $300 a month. They don't care how you contribute it, and you have until April 15th or whenever you file your taxes. So if somebody's like, I really don't know, I'm going to put them in an HSA qualified plan. And then at tax time, they can find out, oh, I went over $1,000. They're going to go to the bank, put the $1,000 in. Maybe they don't have 4,000 to put in. I will let you know that you can make a one-time, only once, contribution from your 401k or IRA into a health savings account. You can only do it once. So for a family, they can add more. It's going to be 8,500 that they can contribute. And again, I don't know how many people who have 8,500. Oh, sorry, this is the limits. The contribution, 8,750. but maybe they had 7,000, 8,750 in an IRA. Because a couple of two, let's just say $2,000 a month, they're gonna pay $24,000 in premium? Just the premium. But if I put their income below so that they're at 80,000 instead of 87,000, I'm gonna put them at about $500 a month. Even if I put them, even if their premium is $1,000 a month for two of them, you're saving them $12,000. So it's, you need to know the income cliff. That's why I gave you that sheet, and you need to have people tell you. So a family who walks in, whether it's one person, or I mean, two people or four, and they're going to make a couple 84,600, and they say, I'm going to make 80, I'm going to make 90. Okay, $90,000. Well, it's 84,600. They need to put at minimum 5,400 into the HSA, and that will put them, that will qualify them for tax credits. A plan with tax credits on the marketplace is going to be cheaper than the alternative plans 90% of the time, particularly people that are in their 50s and 60s for sure. Younger people, maybe not, a 26-year-old making 50,000. Sometimes the marketplace is not cheaper. But if their income is enough, they're 90,000 for a family of two. Hey, if you go put in 5,400 into the HSA, your plan will go from 2,000 to 500 or 600. It's usually cheaper than an underwritten full major alternative plan. That's why the HSA, somebody on the marketplace said, is this really going to be a thing? HSAs are a thing. Whether you're doing it a traditional HSA plan or whether you're just in a bronze plan. So when should you do this? Well, if the client is going to have surgery and they're going to stay in the hospital, they already know that they're going to have a big major thing. Well, instead of paying 10,600, they could pay 85. If they already have an HSA, okay, they're going to want to keep contributing. They already know how it works. All right, let them stay with that. Client's income is just over 400% of the FPL. They're either 4,000 all over if they're a single, or they're 8,000 if they're a family of two or more. If they're young and healthy and they want to save, it could be a great way to save for future. Now, again, this could just be a traditional bronze plan at this point. If you're self-employed and you need to make some deductions, this is a really easy deduction for self-employed. And if you are a person or your client is a person who always reaches their max out of pocket, could be prescriptions. They got some really high medical prescriptions and they always reach their max out of pocket. Well, would you rather pay 8,000 or 10, right? Put them in that HSA plan if they always reach the max out of pocket. That max out of pocket is going to be big this year. This year, it's not as big of a difference because it's like 82,092. But next year, over a $2,000 a month or a year savings on that max out of pocket. Here's the advantages. You can invest. You get triple tax advantages. It's tax-free when you pull it out. You can pay for your medical expenses. You can also just keep contributing and keep building. Usually the premiums are lower, not always. Lots of flexibility. In fact, I think anybody who goes to alternative medicine places should be put in an HSA. If they are somebody who goes to acupuncturists and neuropathic doctors and all that, they can use that HSA money to pay for those things that their regular insurance isn't going to cover anyways. It's your money. You can just keep stacking on it. Anybody in the household can use it. So if you have somebody who's 65 or 66 or whatever on Medicare and the other spouse is 62 and is contributing their $4,000 to their HSA, they can still use that to pay for their spouse's medical expenses. You can't contribute if you're over 65, but It's household money for medical expenses. So lots of options. Oh my goodness, there's so much that you can use it to pay for and have tax free. There is a disadvantages is that higher out of pocket healthcare costs if they get rid of the $0 deductible bronze plans. We'll see. You do have a 20% early withdrawal penalty for non-medical expenses. So the money that gets put there until you turn 65, you need to leave it there unless you're using it for medical expenses. Once you hit 65, you can take it out and just keep it, buy yourself an RV, and you don't have to pay withdrawal fees. You just pay the taxes on that. Or if you just keep track of all your prescriptions and all of your medical expenses for 10 years, you can just pull it out. The disadvantage of an HSA is the prescriptions. If somebody's in a tier 3 prescription and your insurance company gives them tier 3s at, let's just say, I'm going to go expensive, $500 a month. With an HSA plan, they're going to have to pay full cost, whether it's a 3,000, 4,000. So sometimes the HSA, even though it may cost them more over the year, a traditional bronze plan might give them some savings. Unknown costs at the doctor, unless there's a copay, and you need to be able to contribute that money and leave it there. Now, I have a lady who has an HSA, and every year she keeps just the minimum amount in there. And then what happens is that when she gets a medical bill, it's $200. She puts $200 into the HSA and then pays the bill, and then at tax time can subtract the 200. Because she doesn't have a lot of money, but she's like, if I'm going to go to the doctor, I want to just have it tax free. All right, I know you guys had questions, so I'll get to there in a second. But because this is on the slide, we're going to take a small commercial break. Those of you who don't know, I am having a masterclass in September. So if you like my style, I'm having a really deep dive. If you missed the weekly meetings, we'll come to this. It's going to be 3 days, intensive, really deep diving into agency stuff, smarter open enrollment, alternative plans, ICRA, QSERA. It's only for 20 people. I think August 12th is the last day anybody can enroll. I think it's August 12th. And I don't know how many are left, but it's going to be worth it. You get 3 days, one-on-one, and you are there, August 1st. You're going to have a really great deep dive. And I'm telling you, it's going to be a conference you've never been to. It's small, it's intimate, and I have a personal guarantee. If you don't walk away with stuff you can take home and implement right now, if you went, you know what, this is what I thought it was going to be, I will give you your money back. No questions asked. I don't want you to think, is this really what's going to happen? And I am going to have a free master class. I'm combining with somebody else. So if you sign up today, you'll get that free master class. That is going to be really deep dive into the federal changes. Me and Brandon Elliott are going to be doing that from the ACA training ground. All right, I'm going to come back here to the questions. So Ryan, I hope that answered the point of an HSA. So how is this going to be affordable for families? I know the tax credit is what makes it affordable for the premium. The ancillary products is what makes it affordable when they use it. My personal belief is if you are an agent and you are not telling your clients about the gap things, I actually think it's unethical. That max out of pocket of $10,600 is insane. And your clients need to know it's there. They need to see that gap and then go, hey, by the way, here's the ER bill. Can you afford $1,800? No. Well, an accident policy is only $32. You need to be offering that critical illness. If you get cancer, heart attack, stroke, you are going to reach that max out of pocket. Can you afford it? I don't know about you. I don't want to pay $10,600. I can't afford that. I'd be on a payment plan for years, right? But I could have a critical illness policy that only costs me $20 a month and it'll give me $30,000, right? And the younger they are, a lot of them you can get locked in. Indemnity plans. People who are not used to paying when they go to the doctor because maybe they have that HSA. An indemnity plan is going to give them cash. So you have to offer it. That's the only way it's going to be affordable. Now, over the 400 and can't do an HSA, again, we'll be talking about alternative options at a later date. You said go to the HSA bank and get it set up. You literally just go to your bank. Now, Wells Fargo does not do HSAs, and there's another big one that doesn't do HSAs. But co-ops, I mean, most banks do, or you can go to HSA Bank online and create one online. You just tell them you would like to open an HSA. That's it. Now they may have a minimum, you have to have 50 bucks in there. Don't open it this year. Well, you can open it this year for 2026, but don't put money in it this year. It's not going to help you. You have to wait until January 1st to put money in for 2026. So make sure your clients don't go, all right, I'm leaving the office. I'm going to the bank. I'm going to go, I got money in my IRA. Hold on, hold your roll. You have to do it in January, but it's usually pretty simple. They cannot go over the limit. I will tell you, the government says, 4,200, and I think I put $4,210, and I basically had to pay like $20 in fees. So you can't go over the limit, and your bank isn't going to tell you. You just get a tax document, and the IRS also gets that tax document. So there is a limit. I have a new enrollments selected HSA for catastrophic coverage hospitalization, and they want to use out-of-network providers. They can. You can use your HSA money to pay for those out-of-network providers. And don't use your insurance. If it doesn't cover out-of-network, they don't even need to know you have insurance. So like I said, people that go to alternative meds, and maybe they've got, I can't remember what it's called now, where, direct primary care. That is now officially an HSA qualified plan. So if somebody they just want it for that catastrophic in case they end up in a hospital, they break their leg, and they have a direct primary care, they can use that HSA money to pay for that direct primary care. But they have to be enrolled in a qualified plan. Right now, they're saying bronze and catastrophic. We'll get more details as it happens. Explain the difference between tax-free and tax-deferred. So tax-deferred is your IRA, your 401k. You get tax deductions now, but you're deferring the taxes for when you pull it out. A Roth IRA, you pay it with tax money that you already paid taxes. Then when you pull it out, it's tax-free. Same with now an HSA, you get it both ways. You get to put $1,000 into that HSA account. Your income comes down by $1,000, and then when you use it, you don't pay taxes on it. It's brilliant. It's the only tax-free money out there, legally. I suppose you can money launder. If a person is 65 but still working and electing to take their Part A, can they keep contributing to the HSA plan through their work? No. If they enroll in Medicare, no more HSA contributions. And HSA contributions, by the way, are really per month. We kind of talk about it per year. If somebody is turning 65, and this comes up, somebody's in my office, right? They're going to turn 65 in July. And it's a single person. And they're like, oh, I'm 4,000 over. And I'm like, well, unfortunately, you can only contribute half because you're only in an HSA qualified plan for half the year. They don't get to put all 4,000. They would have to put 2,000 to. So once you are enrolled in Medicare, you are not HSA qualified. Now, if they're on a group plan and they do not take Part A or B, then yes, they can continue to do that until they retire. But again, it's a prorated amount. If they retire in February, they cannot go, oh, I'm going to put all the money in January. Nope, they have to do that. So they cannot enroll if you are in a Medicare. Financial planners love HSAs and recommend them all the time. Correct. It's a brilliant tax deduction, especially for self-employed people. When you have somebody who's self-employed and they're like us, we work in an office. We don't have a lot of overhead. An HSA is a way to bring their income down. Now, I remember I had a farmers, husband and wife in my office, and we were talking about the cliff, and their income was kind of close, and because they were selling cattle, and he just starts grinning. I'm like, that's a really weird response. And she looks and she goes, oh, we're getting another tractor, aren't we? All right, he had a really big deduction he could do, right? If you got self-employed, I got somebody, he's a metal sculptor, and some of you heard my story about him. He's got something bigger he can buy. He needs to buy new welding equipment. I don't know. But this is also a way to reduce that taxable income. If somebody is really not sure where their income is going to be, and it's not, we're not talking, I don't know if it's going to be 50,000 or 100. If they're really not sure, you really should be putting them in an HSA qualified plan, whatever that's going to be for next year. Because remember, if they go over by $1, they pay it all back. So unless their financial advisor tells them, yep, not a problem. I love it when somebody walks in saying, my financial piece of paper, my financial planner says, here's my income and I'm fine. Because guess what? I'm not responsible anymore. The financial planner is. So if they go over, not my fault. I love it. So talk to your financial planners, right? I'm telling you, that is one of the most brilliant mergers of networking you can do. And accountants. Go out to CPAs. Go out to the accounting firms that are permanently here and tell them the same thing. Some of them haven't been doing accounting since before COVID. They've never had to deal with the cliff. Some of them think they can just contribute all the time. Oh, somebody's in a short-term $10,000 deductible with United Healthcare. Well, 10,000, that's a high deductible plan. Well, while it is, it's not really a qualified high deductible plan. Now, Congress just said catastrophic and bronze plans. I don't know, is a short-term plan going to figure out a way to say, here's our bronze catastrophic plan? And there are some HSA qualified short-term plans, but accountants don't always know how that works. You just go to the bank and they know what you need. Yeah. They don't even ask for proof. It's not on them to see if you're even in a qualified HSA plan. You just tell them you want to. I will tell you how it works. It's an honor system. The IRS believes you until you get audited. And then they go, show me your qualified plan, show me your receipts, blah, blah, blah. And if you got all that, you're fine, right? You're good. Or if they find out you were just in a $10,000 short-term plan, they're going to go, that wasn't, no. And you know, the IRS isn't a dollar for dollar. There's going to be a dollar for dollar and a penalty and interest of what you should have been paying. So that's how it works. But the bank, they just go, all right, let me know. And you just send it in. Brian, could you do this last minute if you know you could potentially go over the cliff? You can contribute HSA into an HSA last minute. But when you sign up for a plan, if you put them in a silver plan, you can't just suddenly change them into a bronze plan last minute. So if they think they're going to go over, even if they're, I don't know, I could put them in that bronze plan, explain how it works, and say, and this is why I'm doing this. And maybe they end up only making 30. Great, they don't have to contribute, but suddenly they made 50 and or 70, and now they need to. Linda, you're asking, is it one time per year or life? I'm assuming you mean the 401k contribution. It's per life. Now, I have not asked a financial advisor if I could do it one time from an IRA and one time from a 401k. That I don't know. But as far as I know, it's one time per life. But I could see, that's a great question. I'm going to ask my financial advisors. Speaking of financial advisors, this is the other thing that your clients, we have clients, and I'm sure if they're retired that are living off of like dividends and interest, they get their money December 31st. Do you think the IRS cares that on December 31st, you just went over the income cliff by $500? Nope. They need to talk to their financial advisor. This might be the year they sell those plans and buy something that's not going to pay. So this is where I said we do a little bit of financial advising. More like financial advising to, hey, you're going to go over the cliff, or you might go talk to your financial advisor. Do not be telling them to sell stocks and not sell stocks, or don't go there. But you're the expert on the cliff. I've also told people, I love, this is the time of year for you to be meeting people who thinking of retiring next year. Or middle of the year, somebody's in February, comes to me and says, I'm thinking of retiring in July. I want their pay stub. I want to see exactly their gross amount minus expenses, their health, maybe their dental, vision, their 401k, and go, so what are you going to live off? Well, we were going to get our social security in July and my pension. And then I go, okay, so if we add this up, guess what? You're over by 10,000. And I've had people go, oh, maybe we should retire early. Yep. Or they're over by 2,000. Like, I mean, it's literally one social security payment. And they're like, oh, okay, maybe instead of asking for it July, I'm going to wait till August. So you have to kind of look. You're going to be more concerned about that cliff. Now, if they're coming in saying, oh, I'm going to make 30, okay. Tell them about the cliff. They should still know about it. But you don't necessarily have to dig dive into everything. Is the contributions more if they are seniors? Yes, you can add an extra $1,000 if you're over 55 to the HSA. That is definitely, if they're over 55, they can add 5,000, right? Or 9,000. The problem
I
is
was inquiring.
full
I'm
amount.
sorry.
Yes.
I was inquiring about the one-time contribution. Can
Oh,
that
well,
no?
it's the amount that you're putting into the IRA or the HSA. So if it's 8,000, you put 8,000. If they're over 55, they can put 9.
Oh, that one too. Okay,
Yeah.
gotcha.
But I don't think if they put 8 and then turn 55, can they add another 1,000? No, it's a one time. So
Hey Chris, just to clarify, so if they're on a bronze plan and it's like it's like a couple months to the end of the year and they're realizing they're going to be over the cliff, can they then put in like a lump sum of money into the HSA?
yep. So the IRS again doesn't care when you contribute. You have the
Okay.
whole year. And you even have up to when you file your taxes or April 15th of the following year. So they
Oh,
could literally wait till February. They do their taxes and their accountant goes, you're over by 3,000. All right, they
oh,
go to the bank, they put in HSA. You have to tell the bank. Now, if I'm in 2026 trying to put money in for 25, you have to tell the bank that. But yes, that's when you can do that.
okay.
Jennifer, you're gonna need to watch this a few times. Totally understand. This is, you need to watch it, redo it. Donna, are you allowed to use the IRA HSA contribution when it's already qualified money and has already received tax advantages? Yes, you have a one time where you can take it and put it in. I'm confused. So putting their excess income in an HSA account will allow them to be on the marketplace bronze plan. Correct. And that HSA will pay the marketplace premium. No. You cannot use HSA money to pay for premiums. The only premium that you're allowed to pay, there's two, is, well, I think there's three, but COBRA and long-term care, and then like your Part B. So you're not putting that money away to pay for the premiums. You're putting that money away to lower the taxable income so they now qualify for the tax credit. That's why we want you to be in there. Traditionally, you would have to be in a qualified HSA plan, but Congress just said bronze or catastrophic plans. So what that means, we're still figuring it out. Like I said, you may be able to do a copay plan, but we will find out. The contribution list says employer, but it can be individual policy and the client contributes to their own HSA. Yes. I know some people think that no, the reason employer's in there is if an employer says, hey, I'll give you $1,000, the employee cannot add another 4,000. They can only add 3. So if 4,400 is the minimum, it's 4,400 period, no matter where that money's coming from. But when they're on the marketplace, their employee is probably not contributing. If their employee is, or the employer is contributing, let's say the employer says, yeah, if you show me you're in an HSA, I'll give you $500. That $500 is not a tax deduction for the employee. That's a $500 deduction for the employer. So, but if it's an individual, this is, as far as I know, once you are fully retired, an HSA is the only way to lower your taxable income. If you're working part-time, I've had people that kept working their part-time job so they could take all of the money, the entire amount, and put it into the HSA, to an IRA to lower their taxable income. Again, if they're way over, then it doesn't matter if they're 10,000 over, I can't get you into an HSA. I can put you in an HSA if you want. I mean, if they're unhealthy and they have to stay on the marketplace, but I can't get your income lower that way. Qualified expenses, can HSA funds be used to pay the premiums on the marketplace? So remember, no, not the premiums, not dental premiums, not vision premiums, but they can pay for glasses. They can pay for dental expenses. They can pay for doctor fees. There's even a lot of equipment you can buy. If you can get that UV ray thing and that qualifies. So remember, go to HSA store, STORE, store online, and you will see all the things that qualify. There's a lot. Is the age 65 or 59 and a half years? 65, Medicare. Once you are 65 and you're not enrolled in a group plan and not on, and then 65 is the limit. And yes, HSA monies can be used to pay for long-term care premiums. That's the only premium. Cobra, long-term care. So if somebody, we've had people walk in, they've got like $30,000 in their HSA. Let's get you a long-term care plan. All right. Frank says, can you clarify your example of a couple making 90K? Since they're over the 400 FPL, they could still qualify for the tax credits if the contribution to the HSA is 5,400. Correct. Because they can't go over 84,600. They're at 90. They put that 5,400. Now they qualify. Chanel's already paid, ready to go to the conference. I'm telling you, you guys, this is going to be the funnest, I got some fun stuff planned for Milwaukee. So I really do like it. I kind of took all the things I don't like about conferences where you're like, it's a lot of vendors, vendor, selling a product. And this is this is definitely more small, more intimate. You're going to be able to raise your hand and get your question answered. So, and Jamie said, with cancer, you're hitting that maximum twice. You are. Often. You're getting it year 1 and year 2. We live longer with cancer, which is great because then you have better chances of getting over it. A for cancer, A for accident, all that kind of stuff. I do not have any promo codes or vouchers for the agent retreat. That is the minimum. Like I said, anyone who gets it will get free things, but it's not anything lower. What's direct primary care? Best way to look that is to YouTube it, but basically you're paying a doctor a yearly fee. Let's just say $1,000. I don't know what it is. Maybe it's 500. And then you get to see that doctor all you want. It doesn't go through insurance. They're like your personal doctor. If a client has in-depth questions about HSA, it's the health agent, not the accountant's wheelhouse. Accountants only know that it's a deduction. They don't know how it works. And you can call HSA Bank. If they want you to sell their product, they will help explain that. I've got to go. We're at the bottom of the hour and I have an appointment. I will look at the rest of these questions. This is recorded. I will be sending, it's always on YouTube. So look up Coach Chris. There's now 3 of them. One is definitely a dude who's an exercise guy. And one is like Coach Christine. I'm not Coach Christine. I'm Chris, K-R-I-S. Subscribe. You'll see it as soon as it goes there. Due to the volume of people that ask for these classes, sending out the reminder doesn't always work because Microsoft doesn't want us to send out more than about 100 stuff. So please, I will answer some of the other questions on here. And we will talk about the alternatives where you're not taking the marketplace insurance with the tax credit and go from there. So thank you very much. Appreciate you all. I know this was a lot, kind of a download. Watch it again, and then email me with questions. I'm happy to help. Everybody have a great month, and I will see you next month. And for those who are coming in September, I'm excited. It's going to be a lot of fun. Bye, guys.